We're in a bull market. You can't be underweight stocks. You have to be fully invested. I think the market should have no problem clearing 7,000 at some point there in 2026. It doesn't honestly feel like a mania out there. It's not a mania. Let's just be clear right now. This is not a bubble. We're not in a bubble.
So glad to be joined by Warren Pies of 314 Research. Warren, great to see you. Your most recent piece from your firm is called Regime Shift. What regime change do you see on the horizon and why?
Yeah, great to be back with you, Jack, after all these years. And uh, congrats on the new show. I think it's going to be a huge success. Regime change. Well, I mean, it's kind of a play on words. Obviously, we had a regime change in the form of the election. And the question that I think that offers up for us is, will we see a regime change within markets? Will we see this much anticipated broadening? We've had some broadening this year. And so that's what we were hinting at in the question that we, just to get right down to where we drilled down in this report was, is the election going to give us an opportunity to buy things that have lagged in this bull market, small caps, mid caps, things like that? And if so, how do you want to position? And to be honest, I don't really. I can understand why people want to go into this as a playbook. I think that small caps, mid caps, both. If you go back to the beginning of the bull market, this is the weakest bull for both on record, just measured from the start, which was like October of 2022. And so I think there's a human tendency to want to buy laggards. It's just, momentum is really uncomfortable. It's probably why it works. Buying the things that have worked and continue to work is just an uncomfortable posture. So we all want to go back to those laggards. That's number one. That's one of the things that I think anyone who's missed this rally thinks they can make up for lost time by buying those stocks. And then I think the second attractive proposition for these mid and small caps is that they have lower optical valuations. So, I think if you strip out, off the top of my head, if I remember correctly, if you strip out the unprofitable companies from the Russell 2000, something like an 18 times trailing PE ratio. Mid caps is like 21 times trailing PE ratio. S&P 500 is at like 27 times trailing PE. And I think that there's a knee-jerk aversion to owning the S&P at those multiples. And so I get the I think that this is the election is a potential regime change. That's what people are looking to play. My conclusion is I'm not convinced that this small cap, mid cap outperformance that we've seen post election, this low quality outperformance broadly defined, is going to continue leading the markets going into next year.
So you talk about a broadening, and that is a greater percentage of stocks and greater different types of stocks, sectors by market cap are leading the index higher and are rallying and going up. So earlier in this year, and definitely a year ago, you would have people on television, market pundits, say it is only Nvidia that's going up. It's only technology stocks going up. No one's saying that now. The best performing sector, one of the best performing sectors, is the financial sector, which has beaten the technology sector. So not something you see. This rally is not narrow. It has broadened out. But you, even though you are have been bullish on the S&P 500, you've got a report out saying that you actually don't think the S&P 500 is overvalued, or at least you make that case. So you're bullish on the overall stock market, and yet you don't, as you said, you don't see there being a broader rotation into the risk-on companies, the companies that led it higher in 2021. The apotheosis of that, of course, is GameStop and AMC. But your junky companies, your companies that are unprofitable, your companies that just IPO'd, their CEOs are going on television. Those types of companies, you don't see this turning into a true sort of orgy of speculation, let's say. You expect a continued rise in high quality companies. Why is that?
Yeah, I mean, I think it's more about risk reward in how I want to play it. So I can absolutely envision a scenario where, and we've been in the soft landing camp. That's our base case. And but soft landing, we're realistic about it. This is a probabilistic type of environment, and it's pretty rare. And a soft landing is going to look at different points in time like a no landing, and then also like a hard landing. And my ultimate conclusion is that my discipline says you don't buy low quality companies in a late cycle environment. And maybe I'm getting the cycle wrong. I'm open to that, and we'll see if the soft landing is immaculate. Then I think you get small and mid caps and low quality and all that stuff kind of exploding in like an early cycle manner. Maybe if we get a whole lot of fiscal stimulus and just across the board tax cuts that are deficit financed, we could also see that. But again, the downside versus upside going into year three of a bull market, it's a mature expansion. The playbook tells you you want to stick with quality, and quality has worked. And so that's kind of where I come down. And I do think when I look out, this is something I've been playing with as we go do our 2025 year ahead outlook, is that I'm seeing a lot more bullishness compared to last year. Like last year, this time last year, we looked around and said, okay, nobody's really bullish on the stock market, and we were getting more bullish ourselves as the recession indicators that we saw early in 2023 were fading. So that's where we came from, and now I'm seeing kind of the early signs of excess optimism, and so one of the things that underpin that is this idea that the Fed's cutting rates. And so therefore rates are going to go down and you can buy rate sensitive areas of the market, which I think are more like small caps, mid caps, broadening, low quality, unprofitable tech, all those things that you just described. I am of the belief that all the Fed cuts that have been forecasted in the SEP are essentially in the price of the 10-year at this point in time. And so the Fed could cut, let's say they've cut 75 basis points. Let's say they cut again December. And then let's say they cut another 50, 75 basis points next year, maybe even 100, depending on where you want to go with that. And I think that's all in the price of the long bond at this point in time. And so if you need the 10-year, if you in your model, or if you need the 5-year, the 10-year, things farther out the curve, yields to plummet to catalyze a rally in small caps, like we're in an early cycle environment that mimics an early cycle environment, then I think you're not gonna get your wish out of the rates market. And so the only way for I think rates to go lower, in my opinion, this is definitely out of consensus, is the Fed's going to have to do more than they priced in the SEP. And my view is that that's going to be a very rocky path to get to more. More is not just going to be an easy, like Powell wakes up at the December SEP and says, actually, the terminal rate is 2.5, and we're cutting another 150 basis points. You're going to need some stress in the economic indicators to come through. And that path in itself is going to be a rocky one potentially for these low quality companies. So when I zoom out on all that, what I'm saying is the risk reward is not favorable. This is not just like a V-shaped recovery coming out of a recession, coming out of a bear market, where you want to own small caps, mid caps, low quality.
SEP is the summary of economic projections that's released every other Federal Reserve meeting. So you think all of the Federal Reserve cuts have been priced into the 10-year, but so the small caps, mid caps are more interest rate sensitive, but aren't they more sensitive to the short term overnight rate than the 10-year, because that's where all the corporate borrowing happens?
Yeah, I mean that's a common retort. But these things are, I look at more like a risk premium type of an argument, an evaluation type of an argument, and where are you gonna where's your money gonna go, and ultimately a consumer argument. Because like these guys are more economically sensitive, and so if we look at the economy, there's a lot of confusion around the economy. One school of thought is that this is a no landing. I could create a whole argument that we're in a no landing environment and the economy is strong. And I see people, I interact with them all the time, who say, actually the Fed should have never cut. The Fed's giving in. They're going to stoke more inflation, yada, yada, yada. But from another perspective, it's a very weak economy. Like something we talk about is uh, existing home sales are at the lowest point they've been, even lower than the trough of the GFC, or new automobile sales are below 2018 levels. So, and we've seen this in the CPI reports, even in PCE reports, is that durable goods are exhibiting outright deflation. So I see it as kind of two sides of the economic coin. And then when we look at like small caps and mid caps, like this is one of the big things, is these are like, this is the banking system. And so you want to, in order for these stocks to perform well, I think you need to free up credit. I think credit creation has to take off. If you look at like real credit growth over this cycle, it's fallen off the trend line. It's actually been awful. So, again, this goes back to some people think the Fed has been totally toothless in this cycle. I don't see that. I think there's been a lot of restriction from the Fed policy. It's just shown up in a lumpy way. And it just so happens that those lumps are showing up, especially in those lower quality areas of the market. So, yeah, I mean, there could be some very short term funding stress that's freed up for these stocks, but I don't think that's the real limiting factor for why small caps have underperformed. I think it's because the lumpy recovery, which really looks at borrowing costs farther out the curve and consumer behavior. And those, I don't see, again, if unless the Fed does more, like we saw a little bit of an uptick, let's say, as we went through mid-year, we had a growth scare. The 10-year goes down to 3.7%. Mortgage rates go down to 6%. We saw a lot of refinancing activity. We saw some new purchase activity. New homes, new home starts ticked up. All those kind of cyclical indicators that are rate sensitive improved, and we saw small caps lead around that period of time. We've kind of all of that growth scare is abated. The Fed came in and had the economies back. Recession insurance coming out of portfolios. All of those things have allowed rates to come back up. So we start this cycle over again. And when I zoom out, without that growth scare, I just think rates are going to normalize the 10-year, let's say more like 4.25, 4.3%, rather than 3.6, 3.7%. Over next year. So I think, again, it goes back to the original statement. I think that the bond market, by and large, has priced in the Fed cuts that are projected in the last SEP.
So you've got this great chart about how poorly small caps and mid caps have performed for a bull market. The bull market started 2 years ago in October 2022, and the entire market has been on an absolute tear. But for a bull market, small caps and mid caps, which normally perform well during the early stages of the bull market, they're up, but they're up nowhere near as they normally are. So you think that the basically bond yields are still too high for small caps and mid caps to do well. Small caps to do well. And those pieces of economic data you cited that are weak. Existing home sales are weak. New auto sales are weak. How much of that is just because interest rates are high? And in other words, it's not an economic weakness other than interest rates are too high.
I think it's a major component is interest rates. I mean, I think those are, you look at, like, again, this goes back to Fed. Where does policy transmit into the economy? Is it the Fed funds rate, which is kind of what you're saying, and if you're buying small caps with a naive view of what's going to happen farther out the curve, you're kind of saying that economic policy or monetary policy is transmitted through the Fed funds rate, overnight rate. I don't think that's how it works. I think it works through borrowing channels, and borrowing channels like 5 to 10-year out on the curve. And so when you talk about everything from mortgages to car loans, falls in that duration perspective or spectrum. And so to me, that's the major issue going on here, is that, and that's when people say, and you can look at credit creation and things like that in the economy again. And this has been a huge debate, the K-shaped recovery, whatever you want to call it. Why have well-heeled, wealthy folks, for instance, done so well during the recovery? Well, I mean, they're sitting on, let's say you're sitting on $10 million in your money market fund, and it's spitting out 5.5 at one point, 5.5% interest rates. I mean, you can't outspend that. Whereas if you're the average guy who wants to buy a house, buy a car, and you've got to borrow, at 7%, 7.5% mortgage rates, and housing prices have done what they've done, you've been priced out of the market. And so I think that's the dichotomy that's taken place, the bifurcation, whatever you want to call it, in the economy, and is ultimately, I think, at the heart of it's a microcosm of that is the market structure. So why have these high quality companies done so well? Why have the strong balance sheets, tech companies? I mean, this is kind of like a well-known phenomenon at this point, versus small caps, mid caps, cyclical companies, low quality companies they've all suffered. Small businesses, they've suffered during this quote unquote recovery. But if you're like an Apple or a Berkshire or one of these mega caps with a ton of cash on your balance sheet, it's hard for you to even to outspend the interest income that you're making. So it's two different realities. And my view is that monetary policy transmits through the borrowing channel, and so that's longer, farther out the curve. And in order to, so the question I guess ultimately we all have to answer is, how are we going to bring down those long-term borrowing costs if we want to really truly have a sustainable broadening of this rally?
What is your outlook on bonds and the 10-year? I mean, inflation has been falling very quickly and very sharply. That should be a drag lower on bond yields, right?
Yeah. I mean, inflation has stalled out a little bit. Disinflation. Again, we go back to the beginning of the year. We said I think we find ourselves somewhere in the middle of this debate. There's like a big debate that's going on right now. So I think it's useful to kind of define the two extremes. Like, there's one extreme that is in the higher for longer camp, and they believe that the economy, the Fed is like, the Fed was never restrictive. Just look at asset prices. They pick and choose different things in the menu of financial conditions, quote unquote, and then they point to that and say, "Look, the Fed was never restraining activity." So this is you know that's we ultimately bond yields have to reset higher. They'll say term premiums are low. Term premiums have to blow out. And if it wasn't for Yellen just issuing a bunch of bills and changing the mix and things like this and that, in the supply, we would have the market wouldn't have been able to take down all that supply. And this is kind of one side, and they all expect. I would say I've heard very dramatic language, like the Fed is at risk of losing the bond market. I've heard just from that all the way to just like, the mortgage is the right rate, and the 10-year is going to have to move up. So if the traditional spread between an agency backed MBS and the 10-year is 180 basis points, then we need to get that up higher. And then you've heard people like Druckenmiller saying we need to have the 10-year match nominal GDP. So that is the higher for longer camp. And then you have another group that's like begging for cuts. What they do is they take, they've been doing this for a long time. They take like the Zillow new rent index for
Mm-hmm.
multifamily, which doesn't really have a whole lot to do with the CPI, and
And multifamily means apartment buildings.
apartment buildings, 5 or greater units. And this is new rents. So this is not the rollover rents. This is just if you're walking in off the street, what your rate's going to be. Where the math underneath the surface that affects the CPI is that you have a whole lot of people renewing their rents that have to catch up to where the market is. So, anyways, let's not get sidetracked. But they take that and they plug it in to the CPI versus like CPI shelter, which has been the main sticking point here. And then they have a whole bunch of other seasonality, and they excuse all the inflation that we've had. And then they talk about supply chains, and they say basically, we're on the verge of a recession. The Fed is way too tight. They need to cut immediately. If we really measured inflation correctly, we would all see that we're actually in a deflationary world, and this is an accident waiting to happen. Look at, and so to me, that's the other side. They expect rates that we've gone through this. They don't think the neutral rate is higher. They don't think the economy has changed over these years. They think it was all supply chains going through COVID. It has nothing to do with the spending, has nothing to do with the amount of the excess fiscal stimulus or the pro-cyclical deficits that we've run in this country. And that's the other side. And I kind of don't see a whole lot of people in the middle. And that's where I find myself, is like, there's truth in both of these stories, right? I see truth in both of these stories. But really what I think is, forget the neutral rate. It's a really academic argument. Like, let's just talk about the terminal rate. Let's just talk about, where's the Fed going to end their cutting cycle? You know, we've done some work on this. Like, the Fed says 3%. Okay, let's take them at their word. The Fed's going to end their cutting cycle at 3%. Historically, just in a very basic way, the 10-year should be about 4.25 if they're going to end there. That's if once they get to 3% terminal rate, then the 10-year should settle out with a normalized yield curve at about 4.25. And then you draw a band around that to account for different variables that come in and impact it. Then we can look at like nominal GDP. That's the Stan Druckenmiller approach. We do like a little, we smooth it out, look at like a 5-year average, do some other things to say what's our nominal GDP model. Our nominal GDP model gave us at last reading a fair value of the 10-year of like 4.45%. So that kind of triangulates with this Fed's terminal rate of 3%, somewhere in that neighborhood. And then we can look at the 3-year rate 2 years forward, for instance, is something we look at, and like that is significantly higher than what the Fed suggests. So that's at like, I don't know, depending on the day of the week, let's call it 3.8 to 4%. So that suggests the Fed can only cut. That's like basically taking all the what emergency hikes out of the curve, subtracting the 2-year out from the 5-year, and looking
Emergency cuts. Do you want to take that again? Emergency cuts.
emergency hikes. No, the hikes. This is saying like once the Fed normalizes policy and gets to the get beyond this 2-year period where policy is
Oh.
restrictive, where are we going to be? That 3-year rate 2 years forward,
Hmm.
it's like 3.84%. So if we put that out there, then that would suggest a higher 10-year. Either way, we come down, we say, okay, let's split the difference and call it like 3 to 3.25. I think that puts us somewhere between in that neighborhood of 4 to 4.5%, call it 4.3 on the 10-year. And that puts us in the middle of these two camps. And there are times where the 10-year goes too far to the upside, which we saw earlier this year. And there's definitely times where it's gone too far to the downside here recently. And we've been playing that range. And I think that ultimately that's closer to what reality is versus these two extreme camps that you encounter so often.
And so you think that high interest rates are a drag on the economy, and you think the 10-year is basically at fair value at 4.5%. But by the way, I agree with you. I think that high interest rates and bond yields are contractionary and low interest rates are stimulative. Some people disagree with that, which to me seems a little crazy. But you think that your reason you're not balls to the wall bullish on small caps or high beta, the junk trade, let's call it, is because bond yields are still too high. But what evidence do you have? And I know you have evidence, you have the data on this, that uh, basically a rally in small caps relies upon low bond yields or a fall in bond yields. Like I think small caps, traditionally there's a small cap outperformance over large caps, and that was in history, and in history interest rates have been way higher now. So I'm sure there's a lot of more recent data that supports your case, but then also super recent over the past 2 weeks, isn't it the case? And you've got a great chart on this, that small caps have been rallying as interest rates have been going up, as bond yields have been going up, which is not normal.
Yeah, I mean, there's a lot there. Number one, I think the 10 years at fair value, roughly speaking, assuming the Fed's terminal rate is right. There's a lot of work that assumption's doing. So if you put gun to my head and said going into 2025, I think there's going to be a lot of wiggles in the 10-year, let's just say. But if the growth scare is behind us, then the next step is, and we've had a couple warmer than I think the Fed's comfortable with inflation reports. I think that the momentum is still higher for yields. So, and you have the Trump trade on top of that. So I think then you zoom in and say, okay, well, Warren, you're saying small caps don't like higher yields. Why are they rallying right now? I think it's kind of wrapped up in one big. Let's just see where this settles out right now. This is part of the Trump trade. If you do, I'm not a huge fan of doing this, but you can do it. Is you look at like decompose the rise in nominal yields and how much of it was a rise in real yields versus break evens. And, inflation's been falling during this period of time, but yields have been rising, which is actually a little weird. And what you can look at is that it's really been, I guess, from that perspective, a rise in real yields, which suggests that the reason we're moving higher is because the market's expecting better economic growth going forward. I'm not there. I think that that's not what I see. I haven't seen anything like maybe Trump and maybe the Republican red sweep comes through and cuts taxes and runs a bigger deficit, which would, I think, be it would be appropriate to have a higher real interest rate at that point. But I think we've got a long way to go before we get there. And I still think the economy is struggling under the weight of borrowing costs where we're at right now. It's a slow struggle. It's not like we're on the verge of going off a recessionary cliff. But like today, we had new we had housing starts. Single family housing starts, the major. If you give me one thing to look at for a leading indicator of the economy, I'd look at single family housing starts. We did 80,000 new single family units this month. That's ultimately, like, we can get into all the reasons for this, but when we step back, that puts us on a contractionary trajectory. That's a recessionary number. You keep printing those numbers, eventually there's going to be layoffs in the housing construction segment. And that starts, in our opinion, in our framework, that starts the clock for job losses more broadly in the economy. Again, that is not the environment that you want historically to buy low quality equities, including small caps. You want to be buying small caps coming out of a downturn or into a cyclical upturn. So, what's the catalyst for a cyclical upturn here? I guess you could be buying them with the hope that it's going to be some kind of policy change from the Trump administration, and there is evidence that could happen. But that's basically where the hope rests at this point in time. But what I'm seeing right now in the data, in the evidence right now, is an economy that's still in the muddle through kind of zone, in my opinion. And again, when you dig through the valuation stuff, like you alluded to, I don't think there's a lot of relative value in small caps or mid caps either. So I'm not compelled on that reason either.
So small caps and mid caps don't offer a lot of relative value, but isn't it true, as you referenced earlier, that the S&P, the large caps, are optically on a trailing 12-month price to earnings ratio, PE ratio, more expensive? And then also, you said you have written before that valuations in the S&P 500 are an unattractive entry point. Still, with the Fed easing and no recession on the horizons, investors cannot be underweight stocks. So you used to have the view that you can't be underweight stocks because the Federal Reserve is going to be cutting rates and there's no recession imminent on the horizon. However, stocks are expensive. However, 1 to 2 months ago, you changed your view, or you at least explored changing your view, and actually you explored the conclusion that maybe the S&P 500 is not overvalued. So I think many people, myself included, have had the view, yeah, stocks are not cheap. They're definitely not cheap here, and they're quite expensive. However, they're going up, and the macro is favorable to stocks. So you want to be, it could be a stock market bubble, but you don't want to be underweight stocks. You want to own stocks. You have now explored the view that actually maybe the S&P 500 is at fair value, and you had a report, which we won't share that many charts from because it's a private report, clients only at 314 Research. But the name of your report was S&P 500 to 7,000. So why are you bullish on the large cap stocks, which optically are the most expensive? And why is the view that the stocks are expensive? Why could that be wrong?
Yeah, that's part of our philosophy is that I think when you do this game enough, you realize you're going to be wrong. You're going to be wrong frequently. And I think that the winners in this make small mistakes and the losers make big mistakes. That's something I worked with Ned Davis for many years. That was what Ned would always say, is that the winners make small mistakes. It's a mistake game. The winners make small mistakes. The losers make big mistakes. So one of those, the way we try to put that into action is, if the market's telling us something for a long enough time that goes against one of our core beliefs, we need to double back and check the premises of that belief. And so I think valuations is a good one to dig into and think about. So we've had this, I think you framed it up well, just to tell everyone where we came from, is we've basically been saying, look, the Fed's easing and there's no recession. We're in a bull market. You can't be underweight stocks. You have to be fully invested. So we've been riding that call um, for a while now, and that's just been our posture. But we've also said, look, we're having a hard time buying what we find to be benign dips because valuations are too high. So, in August is a good example. We dropped 8.5%. All of our indicators said, okay, this is like really nothing. This whole yen carry trade is like made up stuff. And, we're not really worried about anything that's happening. This is just one of those corrections in like all of our short-term indicators, sentiment and other things were firing and saying, you want to buy here. We found ourselves a little paralyzed. Now that was a really short pullback. We didn't have a lot of time to analyze it, but we were paralyzed. Just to be totally honest, we were paralyzed and stuck in our kind of full investment, but we can't get leveraged long here, And the reason is because Valuations have been a hang up for us, saying like, let's do like the same thing everyone else does, the basic, everyone knows the math here. Let's take a multiple for the market. Let's adjust it for interest rates. We could do some cyclically adjusted stuff. It's really boring. Like, um, you can do it even on a sector by sector basis, like, which gets a little bit, I guess, more thoughtful. You can back out a growth rate, and we've done all that, and we get it. It's very basic. It's very, I'd say, mid kind of valuation work. But like, here is the market going up every day, and multiples expanding every day, and all you have is these guys that come on TV. I'm not going to name names, but they come on TV and say, "Hey, this market's in a bubble. We're just in a bubble." And you throw your hands up and say you got to ride the bubble. I think that's really weak. It's a really, you better be careful when you say that. It's just like very weak. Like, everyone knows, it doesn't honestly feel like a mania out there. It's not a mania. Let's just be clear right now. This is not a bubble. We're not in a bubble. This is, if it could be the early stages of something, or like we could be on the foothills of a peak, but we are not at a peak. These people who are saying that, you're going to be saying that for a long time, in my opinion, if that's your thesis. So anyways, we come at it and we were like, where could we be wrong on valuations? Let's just start from ground one, square one, and redo our valuation work and see what comes out. See if there's a way that we can make sense of what the market's doing. Can we convince ourselves? Can we build a convincing enough case that this market is actually not overvalued? And so we started that. We started that project. That was a long-term project. Took us a while to do that. And our conclusion is that no, I think the market, when you adjust for the composition of the market, and then you adjust for the margins of the market, and you adjust for the quality of the market, these are all things that we're at um, extremely unique period of time where all these things kind of cross-sect together. You have the composition is totally different than it's ever been. The quality characteristics of this market are totally different than they've ever been, and the margins are different. And more importantly, you need to understand how margins impact multiples for different kinds of businesses. And this is something that I learned early on as a refining and marketing analyst. So doing downstream oil and gas work. Everything in refining and marketing is about the margin. Like if you're a Valero or you're a Phillips, all you have are those little margins, that the 3-2-1 crack spread type things that you see people talk about. Basically, that's all you have. You're a margin business. And what I noticed back then, because it's all about the margins, all about refining margins, is that the market was smart. The market would take your multiple and compress it when your margins expanded as a refiner, right? And I just thought that was really interesting. It's intuitive, because what the market's saying is this is commodity based margin, right? And as your margin grows, your multiples should contract to reflect the fact that this is an ephemeral margin that you're getting. It's not a moat or something, right? And what I did back then, just this was kind of the first step that led ultimately to this research report we just published here in October, was I would loop through every sub industry in the S&P 500 and look for what's the same behavior. When you change a margin, what happens to the multiple for every industry? And what I found is the less cyclical industries had a totally different beta. Their multiples had a totally different beta to the margins. They had a positive beta, not a negative beta, like these refiners that I was working on. And so you take that and you spin it out into the whole market, and you say, okay, this market is higher quality, different kinds of companies, higher margins, which leads to, we should expect higher multiples. So we put all that together in our report. I mean, I'm glossing over some things here, but I think it's a unique market. And from that perspective, we looked at it on price to earnings. What should we expect price to earnings to be? What should we expect price to sales to be under these different things? And I think that the market is fairly valued, with a few caveats. If we get the analyst growth estimates, if we hit those out to 2026, which are reasonable given the macro environment we're in, then I think the market should have no problem clearing 7,000 at some point there in 2026. And that's again, we're in year three of a bull market. You shouldn't really expect major multiple compression here. Earnings growth 26% out to 2026. I could go through a whole bunch of stuff. But the bottom line is, I don't think after doing this exercise, we previously just kind of glossed over everything, said, okay, 27 trailing PE, we're overvalued. When you look at it with a little bit more nuance, I don't think we are.
Okay, so like in 2006, you talk about how financials and energy, very cyclical business that when the economy tanks, they do horribly. When the economy does well, they do really well. Financials and energy were, let's see, about 30% of the index, and tech was about 18%, 16% of the index. So financials and energies were 14% more of the index than tech and communication services. Now, tech and communication services are nearly half, 40% of the index, whereas financials and energy are now 16%. So much greater percentage of the S&P 500 are companies that are not as cyclical. Of course, everything is cyclical, but not as cyclical, and they can grow much more secularly. They can grow during a recession, during a downturn. They don't need oil to $120 to be growing their earnings. And then also, that's such a really important point. When you talked about beta, you're not talking about beta to the S&P. You're talking about the beta of profit margins of particular industries to the multiples, price to earnings ratio, the valuations of those particular industries. And I know we can only put up one or two charts on screen from this report. If people want the entire report, they got to check out 314 Research, got to be a client. But this will be one of these charts, which is just that energy margins go up, the valuation, the multiple actually goes down, because the margin goes up when oil is $120, but everyone knows this is not sustainable. Unlike in secular growers like technology, utilities, and staples, there, when the margins go up, the valuations, the multiples goes up a lot more. And now you're saying a much higher percentage of the index is these sectors that have a higher beta to margin. So as margins goes up, the multiple goes up as well.
Exactly. And that's the key. Like, it's more, I think that first when I said, okay, well, you got to do a sector adjusted valuation, and we did our sector adjusted, just like what does that suggest for your trailing PE ratio and stuff like that. And it does move your trailing PE ratio up if we were to hold this sector composition constant and then do an average. What we expect the average should be more like 21 or 22 times trailing PE. But that's far from the whole report or the whole story. I think there's a lot of, but I don't explain myself. This is for clients. Again, I don't explain all of it because it's I find this to be like, this is the IP that we provide clients. But the bottom line is, yeah, there's some very structural changes, structural differences that happen to how valuations work and how they interact with different things like margins, and then how that feeds into return on invested capital. For instance, return an ROIC being at 22, 23% for the entire index. It tells you something. It tells you that's a cap weighted ROIC that we did, but it tells you something. It tells you that these companies, and we've never seen this. This is like a dog leg higher in ROIC that we've seen, have the S&P 500 has witnessed. We didn't see the same thing in mid caps or small caps or these low quality businesses. This is a top 100 of the S&P 500 phenomenon. This is a really high quality type of thing, and it tells us that many of these businesses have sustainable moats. The last thing you see in an energy company, as this is an area I know really well, you get no sustainable moats. Commodity businesses are freaking knife fights, and you're just not, you're never going to see a commodity business with a sustainable 23% return on invested capital, for instance, where you could you just keep investing dollar after dollar and creating those kinds of returns. Like, there will be a new entrant who comes in and takes your margin will become competition. And that's not the case for these other sectors that we're looking at. So it's it took me a little while. It was a long-term project for us to do this. And it really did take me a bit to internalize the ramifications of all this. And I will say it was a very controversial report. We had, I talked about this on Twitter. I had a longtime client who told us, we're not going to renew with you. We don't like this kind of research. It really bothered people. It bothers people to say, make these conclusions, these kind of I'd say heterodox conclusions that this kind of a PE doesn't necessarily mean the market's overvalued. So it was controversial, but I think and it's a little uncomfortable. Like it tells me ultimately that's probably the right research, right path to go down for research because I feel a little uncomfortable proclaiming this out publicly, being on TV and stuff, saying this. But hey, this is where the research led us. We would have if we didn't find it, if we didn't see it, we didn't believe it, we would have wouldn't have accepted it. But there's some serious changes that have taken place that aren't just captured by this just headline PE ratio analysis that most people are doing.
And when you look at the earnings per share of the S&P 500, as well as the earnings estimates of the S&P 500, how concentrated is it? So we know that it's not just Nvidia, the stock, that is the reason why the S&P 500 is higher, but a disproportionate share of the profit growth has been Nvidia because the profits growth there has just been so enormous, unprecedented for a market leader in my view. What where is the greatest profit growth, either by market cap or by sector or by single stock, if you want to go there?
I mean, it is definitely more tech uh, centric market in general. We I don't know the exact numbers off the top of my head, but I mean, this market is basically 50% tech by our calculations. I mean, you have the tech sector, then you have Amazon that's in consumer discretionary, and then you have like Meta and Google and things that are in comm services, or you can just take comm services and throw it with the tech. When you do all those adjustments, I mean, this market is close to 50% tech, and that is the straw that stirs the drink. That's where the growth is, and that's what's driven the transformation that we're talking about here. So yeah, I mean, there is in analyst estimates a broadening out across other sectors as you go out into the out years. But again, that's going back to the original question of small, mid cap, large caps. It's more dramatic in in the cyclical sectors within those groups. Like I look at one that stuck out to me. I believe it was in mid cap energy space, had earnings estimates of 70% through 2020 from 2024 to 2026, and a much larger share of mid cap is in energy, and that just is one of those things that I look at and I wonder, how does that work? What are the assumptions that underlie that kind of a growth rate in that mid cap index and in that sector in particular? So there is a broadening effect. I mean, like in order for the S&P 500 to hit its 2026 EPS targets, for instance, which, like I said, is like 26%, 26% above where we're at right now. It's going to take every sector in the market to grow earnings, but not to the extent that you see in these other more cyclical bets in the mid and small cap. So it goes back to that whole how much faith do you have in the growth outlook for the next 2 years? Because there's a lot of faith that you need to buy those small and mid caps.
So the earnings in the S&P 500 actually are at all-time highs now, whereas in the small cap and maybe the mid caps too, they're not. And so people say the S&P 500 earnings growth expectations for 2025 and 2026 are delusional. Maybe they are. It's impossible to know right now, but you're saying that they're far more optimistic and therefore delusional for the small caps.
Yeah, I mean, we actually did. So, like, I don't want to make it like there's nothing to be interested in these groups. So, like, one that is true what you said, that we're still in an earnings recession is another way of saying that for mid and small caps. So, mid and small caps, their earnings are below the previous all time high, whereas we're at new all time highs for S&P EPS. That's mainly like the AI trade, like you kind of alluded to in the big tech trade. But one of the things we did with the S&P analysis, again, to say, is this index, are we overvalued here? We went back and looked at top line growth, which is about 12.5% out to 2026 for the S&P 500. And we said, okay, what does that imply for the macro backdrop? And the long story short is that implies like about 5% nominal GDP growth annualized between here and the end of 2026. And that's not we found out to not be a very high hurdle. So we said, okay, there's nothing we can start with top line estimates, because again, the conclusions we had on fair value of the S&P 500 and all that requires these companies to hit their growth estimates out to 2026. So we wanted to start from the top and work our way down, margins, assumptions, all that stuff. And we found, okay, this is not a unreasonable macro environment. 65% of all years going back to World War II, the US economy's nominal GDP grew at over 5%. So without a recession, I think it's a safe assumption, especially if we're going to run this kind of a deficit, which we are, to hit 5% nominal GDP for the S&P 500, and then top line grows in accordance with that. Now, mid cap top line growth is actually lower. Their earnings growth is higher, but the top line growth for mid cap is lower than the S&P 500. It's like 10% going out to 2026. And when you go through the same analysis, okay, where are we at? What does this imply for the US economy? It implies a very low hurdle rate, like a 4% nominal GDP growth rate for mid caps. And so, from that perspective, there might not be quite as much optimism baked into the mid cap space. And that was one thing we looked at and said, okay, this is a potential positive for mid caps. And we did offer some strategies for how you get exposure to mid caps if you want to do that. But my concern with that is again, it goes back to how the economy has changed and how that GDP is distributed. And we've seen nominal GDP be decently strong over these last few years, yet we've seen mid-cap earnings and top line even struggle over this period of time. It's not like sales has tracked mid-cap sales, small cap sales has tracked nominal GDP. In fact, they've lagged significantly. To nominal GDP. So that's a caveat to think about. But when you just talk about what's implied in the expectations versus history, mid caps don't look too unreasonable.
So expectations for mid cap earnings are very high, but expectations for mid cap sales are not. How does that make sense?
Margin expansion. There's a lot of margins. So again, like a lot of people are worried or nervous. This goes back to relative value in the market. A lot of worry around margins that are implied for the S&P 500, which again, S&P 500, analysts are looking for 12.5% top line growth through 2026, 26% earnings growth through 2026. That implies a big margin expansion, margin expansion to an all-time high, something like 14.4% on margins. And mid caps, same kind of story though, and I'm a more skeptical in the margin expansion story down in the mid cap and small cap land than I am in the S&P 500. So that's what's going on there, is that analysts see actually a really healthy margin environment, which I don't know. I haven't dug enough into to say there's too much real estate to cover there. But the way it looks to me is that this is all going back to a rates story. And I'm skeptical that the rates story is going to play out in that smooth, linear fashion for these lower quality indices.
Warren, you also have an ETF, the 314 full cycle trend ETF. What is your strategy for that ETF? And then also, I'm just looking through the holdings now. It's maybe I'm wrong about this, but it seems like there's a lot of risk off or safe companies. For example, Walmart, I just mentioned. What can we gather from looking at the holdings of your firm in terms of your ETF, in terms of your outlook or the model's outlook? What is the model telling you?
Yeah, it's purely systematic. I mean, the way we built it embeds our philosophy into the ETF, but then we let it run and it's systematic. So the way it works, again, we're quality investors, for better or worse. That's the way for this cycle, quality has been the dominant factor. It's been how we built this model going back in real time, starting in 2021. And it really comes from my time, again, in the energy space. Like if you were an analyst in energy equities from 2010 to 2020, basically, like I was, the one lesson you're going to get beaten into your head is how important it is to buy the highest quality companies in that space. And so we did, when we started the firm, built the full cycle trend model, we started developing quality-based stock selection and then technical systems that work in a quality universe. And that's how this ETF came about. It's built based off this model. So the model works by taking the S&P 500. So that's our universe to start with. We rank every stock on basically a proprietary quality screen. We grab the top 100 stocks by quality, and then we rank those on our own trend ranking system. And what we found, again, this is some of our own research that we found in how the what we do within a quality universe, is that buying dips in a quality universe is a much better strategy than buying dips outside of a quality universe. So once you find the right pond that you're fishing in, you can buy those dips aggressively. And so that's how this model works, is really we look for quality stocks, intermediate term uptrends, and then a short term pullback. And then we cycle through that same list every month. And there's basically 6 stocks that exit and enter the portfolio every month based on that criteria. So the quality universe stays more or less static. And again, you're going to have some stocks are going to have defensive characteristics. But there is like a lot of, there is a decent amount of tech and AI related plays in the universe and in the holdings right now. And so that stays static, and the market or the model will look for, as long as the intermediate to long-term uptrend is intact, it will look for a pullback. And again, the other thing we do that's a little different for all our models is we run regression trend lines on these securities. We do the same thing for our asset allocation model. We find that if you're comparing cross-sectionally, based off of versus compared to like momentum, where you have like a point A versus point B rate of change, taking a regression trend line, let's say if it's going to be over 252 days or 200 days or something like that, you're using every single data point within that look back window. And like, let's say we want to grab the slope of that regression trend line. It's constantly shifting incrementally every trading day. And that allows us to re-rank everything and fine tune our rankings and our systems. And again, we use that in all our models. It's just, all these little things, these little tricks that we found over the years, they add up. It's a better mousetrap when it comes to momentum investing and trend investing. And that's built in to the full cycle trend model, and is expressed through the ETF. So bottom line is quality, long-term uptrend, short-term pullback, do the same thing every month. Over time, that's the recipe for success in stock selecting, in our view.
And is the asset allocation always 100%?
Yeah, it's a long only, 100%, very concentrated portfolio, 20 stocks, equal weighted, rebalanced monthly. It's not going to just track your S&P 500. We've had some pitches to institutional investors where they ask us to distinguish it from some of the big quality ETFs that are out in the market. And it's easy to make that distinction. We're not just hugging a benchmark here. We're not just piling into mega cap tech. It was, in fact, before it was an ETF, it was just a full cycle trend model, and we would decompose the performance every year, and it was doing well. And we would still, at the end of the year, we'd say, okay, how much of our performance came from mega cap tech? Like last year was really interesting. The model stayed with the S&P 500, but almost had no exposure through the year to the mega cap, to Mag 7. And that was interesting to see that phenomenon play out. It has some Mag 7 exposure now. But again,
why is that? Were they not in a long-term uptrend?
No, because they would never pull back last year. So they were never registering. So like the way it worked is a good case study was like July, we bought a bunch of home builders and then sold out of those, because home builders, quality stocks, long-term uptrend. We had a pullback in July or in June into July. We bought the dip, and then those guys ripped, and we just offloaded those securities in August. And so again, those trades, they add up over time. They compound over time. And I think that's, if you're going to try and get something outside of the index, I think you need to have, make some concentrated bets and take some big swings. And it's a good, I think it's a great satellite strategy if you're going to try and add some juice to your portfolio.
And so the ETF came out this year, but you had the model before. What did your model do in 2022?
Oh, it did really well. That was the stress test. Obviously, like the way this ETF came about is that we ran this model for years, and clients were like, there's quite a bit of turnover. You turn this portfolio over, three and a half times a year. So we're generating a lot of gains here in taxes. If you put this in an ETF, you can keep all the taxable gains inside the fund, or our goal is to keep 100% of them inside the fund. We'll invest, and that's how the ETF was a grassroots thing. And so 2022 was a really good year. We came through that year. The market ultimately bottomed in October. The full cycle trend bottomed in June. That first dip in June, and it found some good pockets early on. I think what was the market down in 2022, like 20% or something like that. I think
For
our
the
fund.
year, yeah. Peak to trough, it was more, but yeah.
Right. I think our model was down like 9% in 2022. So for a long only strategy versus the S&P 500 is much better. And I think honestly, that's my inclination. It goes back to the beginning of the conversation. Like, why aren't you going to go, all in on small cap at this stage of the cycle? It's because I'm more about, I think if you control the downside, control the mistakes, the upside takes care of itself most of the time in investing. It's just philosophically how I'm wired. And it was great to see this model go through a whole cycle. That's why I call it full cycle trend.
Mm-hmm.
Go through a whole cycle, go through part of 2021, survive, do okay there, survive 2022, thrive in 2023, thrive in 2024. And that's really what's gotten clients behind it.
And because I could see if I had the same strategy but just implemented differently, I could see a strategy where you buy stocks that have been in a long-term uptrend and buy them after they dip as performing really badly during 2022. So, all stocks in a long-term uptrend, Nvidia, Apple, all the stocks, I feel like those are the stocks that were some of the stocks that were down the most, at least maybe beta adjusted or whatever in 2022. So how is it that your strategy did better again? And this is not real money. This is a model back then. Now it's real money.
Yeah, I would have to go back. I can't remember all the buys and sells we were doing back then, but we never had a big exposure to the Mag 7 back then. It just didn't bubble up that much. I remember us being again, I don't know why it sticks out to me, but I remember us making the model making a big bet on home builders back in June, and just thinking like, wow, these home builders are really, this sell off is really overdone here. And we were buying, there was some tech buys in there as well. But yeah, I don't. It's too far off in the past at this point for me to remember exactly what we were buying and selling. Other than I know, because it was a great buy, and so those types of things stick out to you.
Mm-hmm.
I know we bought basically the bottom in June on the home builders, and I also remember tweeting about it and getting just showered with negativity, and so many people just telling me I was an idiot, and that was like another one of those times where you realize the more negativity you get back to an idea on Twitter, the better idea it probably is. So you learn to like bathe in that. But anyways, that's what I remember from 2022 on the model. If anyone is interested, if you go down this with us, what I will say is we've run tons of analytics for anyone who wants to invest with us or is interested. We'll run every single holding that the model's ever had, every monthly performance, yearly performance, all the statistics that you could ever your heart's desire. If you reach out to us, if you want to follow the model or consider the ETF, we make it all available.
Mm-hmm. And then what to you counts as quality? Because quality, there is a mathematical definition of it, but also it you can weight things very differently.
Yeah, I'd say it's pretty meat and potatoes. We really believe a lot in return on invested capital, kind of like we were talking about with the market. So ROIC, that's in the literature. One of the reasons I like quality is it's a little undefined. Like value stocks, you get into a lot of like price to book and things like that, which it kind of oversamples or pre-selects for certain types of businesses. And
Companies
I
that have a low return on equity, because if they have a ridiculously high return on equity, of course they have their expensive price to book.
Right. And so I think that almost value and quality a lot of times are two sides of the opposite sides of the spectrum, right? One thing we do in our quality definition that's a little different that I talk about in public is you could do like earnings volatility is like a common sort of like quality adjacent metric. And so you wrap more or less standard deviation bands around your trailing earnings estimates or trailing earnings results, I should say. One of the things we do is we run like a drawdown function on earnings in our analysis, and we'll go back multiple years and then look for earnings drawdowns. So we're only looking at downside and only penalizing downside moves. So if you level shift up in earnings, you're not penalized, which happens if you're just wrapping standard deviation brackets. Your algorithm's reading this as, oh no, we had a big shift in earnings. But if you don't give that back in the downturn, then we're not penalizing you in our system. So there is some nuances in how we do it. Again, like all these things is pretty meat and potatoes. It's quality, basic quality stuff. We tweak some of the metrics in the background in ways that we think look better, like in that way using drawdown versus the earnings volatility. When you talk about like trend overlays, we like to do regression trend lines. And again, I'd say the most insightful thing we found in this space is just the different results you get from buying dips in a quality universe versus a low quality universe. I think that goes back to your point, is like, well, wonder why the model did better. If you go back to almost every bear markets happen, there are drawdowns in the strategy. Like, don't get me wrong, it's a long only strategy. There's nowhere to hide in a GFC. There's nowhere to hide in a COVID. In 2022, even, I'm proud of the performance and everything like that of the model, but it's still down. It was still a rough year, right? But the point is that over time, when you cycle through this process, you're buying the dips of quality companies. Logically, you're expecting that to resolve to the upside. Whereas if you do the same thing for the rest of we do a quality 100. It's our system. If you do the rest of the S&P 400, the remaining 400 non-quality companies, and you buy the dips there, the strategy falls apart, and you get much larger drawdowns in your equity line. And the same thing goes for mid caps and small caps and other. It's a robust, I'd say, interaction between dip buying and quality that we find across different universes.
Warren, so in your model portfolio, not for the full cycle trend thing, but just your overall asset allocation, in 2022, I remember we did interviews talking about how oil actually was a good hedge, because on days that the stock market sold off, it was because the price of oil was spiking. Those were very correlated. So there were times, during that period where you're fairly overweight commodities in your asset allocation model portfolio. Now I noticed recently you've downgraded commodities to an underweight. Say commodities have been underperforming. This year, stocks have been on fire. Bonds have done okay. Credit-sensitive bonds have done well. But commodities really have been dragging down. And maybe that's why we've been in a soft landing. So prices have been going down. The rate of change of inflation has been going down, and prices of commodities have been going down. And that's allowed, inflation to go down without there being a recession so far. Why are you underweight commodities now? And how much of that is quantitative, your current process, versus a lot of commodities? I believe a majority is oil, and you are a veteran oil analyst, and it comes from that background, that analysis.
Yeah, this has been a little bit of a dilemma for us. So again, I think models, we say that there's really two ways to get an edge in markets. Broadly speaking, you can do it through better data or better emotions, and we don't have any better data than anybody else. So we've got to work on our emotions. And the best way to control your emotions is through a model driven process. And so that's what we say. If you want to have the most attainable edge is an emotional edge. And the best way to get that edge is through models and systems, frameworks. And so that's really the cornerstone of our whole company. And it does create a dilemma sometimes, because it's not a panacea. It doesn't mean you're always right. And there can be times where you have to override your models. And so one of our models, which I spent a large part of my career building, was our crude oil model. And it's done very well in real time. It's done very well for us and for our clients. And I frequently will say that this crude oil model trades the commodity much better than I do. And that's mostly true, because I'm just like a dumb human like everybody else. And I make mistakes and have my own biases and stuff I don't even know exists. So anyways, this has been a rougher year for the model, and it's been just so happens it's been a year where my gut and instincts and just following the market has done better. And so it just happens. And so we recently, models on a buy, and we recently went ahead and went against the model in our strategic recommendations, which sounds a little confusing to people listening at home. But the bottom line is like, what does Warren think? I think that I want to be underweight commodities, and I want to be underweight oil beta at this point in the cycle. Um, I do think that our model sees things that are basic, like it sees that there is a deficit in the market right now. It's expressed through, you can see that in the curve. The curve's backwardated. You can see physical market indicators that suggest there is a deficit still in the prompt crude oil market, which is all else equal is a bullish thing. You also can see in the model that short positions for hedge funds and other speculative traders have gotten very elevated. So you want to usually fade that. So you got a deficit in the market, a built up short positioning in futures, and this is a over time. This is the right recipe to get long oil. What I see going on out there, we've had this kind of setup really since May. Models did great, called the rally coming into Q1. My view is that we would get to 90 and that we would then test the 50s on Brent at the very end of this year. So here we are in that weak seasonal window. The model doesn't know about the seasonal weakness that comes here typically around November to December. And more importantly, the model doesn't know about what's happening at OPEC. I think that's what's stealing the market's attention right now is everyone knows OPEC's coming back with that supply. And it's a matter of not if, but when. And I just think it caps upside. If there's a big move higher in prices, even a modest move higher in prices, OPEC's going to sell into that, in my view. So I just think you're sitting in a situation right now. Could OPEC try to save the market again? Sure. They've delayed the unwind of the cuts now a couple times. They could kind of continue to kick the can, but it hasn't gotten you a price response. We've had geopolitical things that have flared up. They have not gotten you a price response. You need to take a signal from all this stuff, in my opinion. So we're in a really weak seasonal period. Oil rallied here recently with some other headlines, and who knows? We could get a quick 7-8 barrel pop. It's oil. Things happen. But if that were to take place, I think OPEC comes back into the game, and our model is just not equipped to see that. It doesn't see that supply sitting out there. Sitting on top of the market. And so that's the dynamic. I mean, there are always like a million things rabbit holes we could go down for oil, but where I'm at right now, I think that's the most important factor. And it's got a negative skew to your return profile for oil.
And do you think that the Permian U.S. production will continue to grow?
I mean, it's all path dependent. I don't think Trump's going to change it if that's what you're getting at. Like, I don't think, I had a lot of clients ask me, like, has your view on oil changed because Trump comes in? It's like, no, not really. Again, like, I think that it's mostly talk. Like, I don't think Trump is going to be able to increase production here. So what could Trump do? He could put sanctions back on Iran. I think it's a little harder to do that than assumed. We don't know if the sanctions regime will work or how that will when that would take place. I've heard some rumors that Chinese refineries are looking for alternatives to Iranian oil. So maybe I'm wrong about that, but I don't think that Trump's going to do anything I mean, he's not even president right now yet.
Mm-hmm.
But I don't see Trump doing anything in the here and now to stop the flow of Iranian oil. And then the other hand is what happens with Russia, Ukraine, and does Trump in that do something to bring about the end of that conflict? And when it does happen, as part of that inevitable ceasefire, whatever, will we reintegrate Russia into the world's energy network, energy markets? And what does that mean for price? So I have no idea how to weigh all this stuff, but I don't see Trump as a clearly positive or negative for crude oil, and I don't think that the market is equipped to trade off of him. Like I've said before, oil is the shortest duration asset on the menu. It can't see past its nose. It trades off the prompt market, off the physical market, and it tethers itself to that, and then it can go just a very short period out. So like when you have the OPEC oil coming back, you'll see that takes place in the futures market. The paper market will sit there on top of price and sell off. We saw it also like back in 2021 when the Omicron variant came out. Paper market got really bearish. It didn't change the near-term supply and demand balance in the crude oil market, but price fell because of the paper market. So that's as far out as oil can go. It can't go to end of 2025 and what Trump's going to do. It doesn't discount future events like the equity markets. It's
It's not priced in. Yeah, people say the stock market is forward looking. The oil market, you're saying it's not. Like in February when 2020, when COVID was spreading around the world, oil did not sell off. It didn't go. It just when people stopped buying oil and it overflew, it went negative in April 2020. So it's not a forward looking mechanism. Do you have any views on like offshore production, LNG exports, that kind of stuff?
No, I haven't updated anything on that recently, so no, nothing worth getting into there.
Got it. So you personally are bearish on oil, but your model is still neutral, but you downgraded the model personally.
Model's bullish. The model's on a
Model's
buy.
bullish, but you're not.
Model's on a buy. But I'm not. I'm bearish. So it's just a classic. This is a classic. I'm hoping clients get something out of watching me, make these decisions in real time. Like a lot of times what I say is like our institutional clients, they pay to watch us struggle with the data in real time. And part of that struggle is you have all these models, you have all these indicators, you have all these systems, you follow them 90% of the time, but you override them 10. How do you come to the decision to override a model that's been working for you pretty well? And so that's where we're at right now. Model's bullish, but I'm bearish. And I've been given the model the benefit of the doubt all year, since the second half of the year. Um, but I'm at a stage now where we're in this window that I've identified. I identified it 1 year ago that we're going to have this end of 2024 is especially problematic for the oil market, and I don't want to. I'll kick myself if I lead clients into that just because of this model, and I can see the issues that the model could potentially have with this environment. So, yep, I know that's not the most. You want to make headlines and make compelling statements and stuff like that, but this is the truth. This is where the posture right now is. The model is bullish, but I'm bearish. And in our calls for clients, I'm going with myself in this one with what I see.
What about gold?
It's still bullish gold. We said we thought gold would be at 25, would hit 2,500 an ounce coming into the year. Obviously, it did that. I think that the dollar rally is probably a little stretched here, and ultimately, the only thing that concerns me on gold, to be totally honest, would be this Bitcoin rally is just crazy, and so I do think there's a displacement effect, and I've kind of our model's long Bitcoin too, but if we're really going to if the Trump administration is really going all in on Bitcoin, you could see like the flows just really change, and that would be the negative for gold. But I think this is the right environment for gold still. I'm not changing my view on that. I've been saying I think we're getting to 3,000 now. Still feel that way. Still think that's the case.
And what about gold? Sorry, what about Bitcoin?
I mean, how can you not be bullish on Bitcoin with what's happening? This like chatter of like a national Bitcoin reserve and all this stuff. Like, I guess it would be like the 21st century version of Fort Knox or something. I'm not a Bitcoin maximalist or anything like that. I've said many times, I think there's just, I would say if anything, I'm more of a skeptic on Bitcoin than anything, but I definitely see a use case. It's not like I think it was Howard Marks, like a few years ago, we wrote a report on it and quoted Howard Marks, and he was calling it a Ponzi scheme. And we said, it's not a Ponzi scheme. There are use cases. It's a store of value. It's a transfer of value. It's a cross-border transfer unit of value, just like, a collector's item or a piece of art from, many, many years ago. And so that's what we see. It is not going to like displace the dollar or like free I don't know, free us all from the shackles of government or whatever the, big story around it is. But the bottom line is, if it's a flow story at this point, if the current administration is going to come in, they're going to deregulate it, open it up, and then potentially put their thumb on the scale. You got to be long Bitcoin.
Yes, I'm with you on the skeptic. It sounds like you're a skeptic, but you're not a bear. I'm also a skeptic, but not a bear. I just feel like I really don't understand it, but a lot of money is going into it, and it just keeps on going up and up. So, it's as a trading vehicle, it may not be, it's a trading sardine, not an eating sardine for me.
I look at it a lot like gold. Like, some old school people have a real problem with Bitcoin, but like can really like gold. And I don't really don't. I mean, I see them as really the same thing. The only difference is obviously you can hold gold in your hand, I guess. And so, but really, that's a difference without distinction. You know, what's the? That's really not. It doesn't mean anything. They are both like kind of unproductive assets, store of value, hard to debase, limited supply, all those factors, kind of monetary assets. I mean, I don't have any. I know there's like a million arguments that'll come back from gold bugs, and it's like I get all that. It's very basic, but at the core, they're virtually the same asset.
Yeah, I mean, gold's a little bit older.
Yeah, it's got a longer history, but when you strip all those things away, gold doesn't do anything. That Bitcoin doesn't do anything. Gold doesn't do anything. It's a
Yeah.
store of value.
When you say use case store of value, I mean anything could be a store of value. Like seashells could be a store of value. It's yeah, it has a use case of people buying it and it going up, and a store value. A store value.
Has monetary properties. Has it's a it's a like I forget who it was used the comparison to like antique books or artwork, and how that what was the purpose of antique books and artwork that we could cross borders and transfer wealth from one country to another. That was what we found with Bitcoin. It was like, what's the real use case for Bitcoin? Well, it's getting wealth outside of jurisdictional boundaries, from taking it from one place that treats capital poorly to another place that treats capital better. But ultimately, it's not like you're gonna have to get your Bitcoin to the United States from China, and then you're going to convert to US dollars. Ultimately, it's not displacing the US dollar or anything like that. You're not going to be like buying real estate in Bitcoin. You're going to be getting to the US. Then you got to have a way to liquidate that Bitcoin and get yourself into whatever jurisdiction, US, Canada, whatever it is, out of China, let's say. And so we did that research all the way back in 2021 when the first real furor was taken off. And I think that research has held up pretty well.
Warren, a lot of some reasons why people like Bitcoin or attracted to Bitcoin is because they believe in the fiscal unsustainability of the United States. The United States has a deficit that just grows and grows. The debt just gets bigger and bigger. The U.S., interest payments on the debt are going higher and higher as the debt gets bigger, as interest rates get higher, and that has a compounding effect. You've had a piece on this recently. Where are you? Describe your views on this.
Well, I mean, I think that the deficit is a policy decision. Ultimately, this is like you need like it's not about we can't pay that debt back. Like the U.S. can print dollars to pay the debt back, and MMTers have done a good job adding to the dialogue about that. And so like it's much like whenever you hear somebody talk about the U.S. in kind of take it and jump the analogy to a private sector actor, you're dealing with a confused person.
Mhm.
So that's the first thing. I think that's kind of out in the market and people know that. So I'm not in this, oh, we have a problem with our deficit. How are we going to pay it back? We'll pay it back by printing money. The negative consequence of all that is ultimately inflation. I'm also not in the camp that says you can run deficits like this and not have consequences. Like I think that I can't believe that there's still debates on Twitter on what caused the pandemic era inflation. Yeah, there were some supply chain issues, but the problem was the amount of fiscal spending. Clearly, I mean, you can run the thought experiment. It's very simple. If there was a supply constraint that hit the economy, we didn't add any dollars to the economy, prices would go up and then come right back down to where they were after the supply constraint is alleviated. What we saw, if you look at just like the unchanged CPI, not the rate of change, but the actual index, you were going up and then you level shifted higher and you're never coming down. And we all know you're never coming down because the government spent so much money into existence. So I think that it's a real issue. I think deficits are a tool for policymakers when there's a lot of slack in the economy. A fiscal deficit is appropriate because it marshals idle resources. But when you have a tight economic capacity like we have right now, I think you end up crowding out more efficient or productive economic activity. So I do believe in crowding out, and I do believe there are negative consequences to the deficit. But one of those is not that we're going to be able to pay it back. We'll pay it back. We'll just pay it back with debased currency.
Yeah, when you say we'll pay it back by borrowing more. So we never will pay back the debt. We will just pay back existing debt with new debt and refinance it. And yeah, I mean, things can't last forever, but I think this is ultimately a long term question. And if people who are have been pulling their hair out about the deficit for 10 years, maybe they'll be right in 2040, but they're not going to be right in 2026. I don't think. And I'm reading a book now about World War One, and it's funny to me how like a lot of the trends of the increasing hostilities between the belligerents like had been brewing for 30 years. So it's funny, like in 1890, if someone made a prediction that there's going to be this great war, and 1905, like they've been writing that war newsletter for 15 years, and they would be wrong for 9 more years, and then ultimately they'd be right. So it's just ultimately a question of time horizons, like many things.
Yeah, I think a lot of people. My One of the things I like to say is like people like to skip to the end of the story without reading the whole thing. Like, and that's what I feel like you do. That we see a lot with like investing is like you kind of like game all this stuff out, and you get to the end, and you're like, oh my gosh, this ends at a certain place, and so then we need to do this today. And in fact, there's a long time between here and there, and you might as well like manage the cycles in between here and there. I'm not like I'm not in politics. I don't have any way to influence politics. So I'm not going to try to make normative statements to the government or to the Fed. And like so many people waste a lot of their time where, no one cares what you think, but they're still like, telling everyone what they think about like voter ID laws and what the Fed should do. And I, has, does, I can't impact that stuff. So, why would I try? I don't, I just react to reality. I just deal with reality. And to me right now, yeah, the deficit will be a problem at some point in time. It's going to manifest itself through probably issues in the bond market. I don't think that's anytime soon. I don't think that that's in the outlook that we're talking about in this podcast that people are listening to it care about. But I'm not like dismissing it either. I'm just saying it's off in the future in the distance. And the one thing I've seen is that there's just been a real tendency to overestimate the timeline, the shortness of the timeline that these calamities happen. These things are slow burns and slow boils. I mean, there's so many levers that policymakers can pull between here and there to change the direction of where we're going. And so I just think it's an issue, and like we're running pro-cyclical deficits, and that's a huge part of the outlook right now. But it's not like the bond markets, the bond vigilante thing. Even don't even get me started on that. I'm
I've never
not.
met one. Never met one.
I don't think they exist.
I've
I
met
don't.
people who think of themselves as a bond vigilante, but I've never met an actual one.
Yeah, yeah. The Fed. I love this new line of reasoning, which I know I'll piss a bunch of people off at this, but it's like there's this new line of reasoning that like the Fed doesn't control the bond market, and the bond market is just like and the evidence is the Fed cut rates in September, and the 10 year has gone higher, and
Mhm.
like and I just think that's just so ridiculous. And it's fine with me. Like I would love to trade against those people. I'll trade against them all day long. They have a bad mental model of the world, and it's not going to work out well for them.
Well, I think we probably agree on this, but the Federal Reserve literally does not control the 10-year rate as they control the overnight rate, which they have, 99% of the time they have complete control of the overnight rate, higher than 99%. But the 10-year rate is buyers and sellers, and the Treasury issues it, and there's a demand for it, and it's based off growth and inflation, and then also the future path of policy. So if the Federal Reserve wanted to get the 10-year down 100 basis points, uh, I think they probably, I mean, they could do it by just buying a ton. So they have near infinite power, which they rarely use. So because they rarely use it, I think they don't have control. But if they wanted to, they could. That's my view.
Yeah, I think what you said is right. Like on very simple, how does the bond market work? In my view, it's future interest rate policy plus a term premium, and that's like over some because there's so much embedded in all that. But that's the bottom line of what equals the 10 year in my view. I heard someone say it once that um, the 10 year is like a dog on a leash and the Fed is walking it. It's not the 10 year walking the Fed. The Fed's walking that dog. And the leash, they dictate how far that leash goes with their forward guidance and interest rate policy and everything else. But as you alluded to, if the Fed wanted to, it can I it could just say what the rate's going to be for the 10 year, and then that'll be it. It would just be like open market operations on the 10 year, and like instead of quantitative easing, they would do qualitative easing, yield curve control, whatever you want to call it, and
Mhm.
just set the price. And they could. So no, the bond market doesn't push the Fed around. The Fed pushes the bond market around. Uh, Maybe that changes one day in some way, shape, or form. Like like this is where the fears of all this stuff ends. But we're not there right now, and we're not going to be there anytime soon, in my opinion. So I'm not going to change my mental model yet. Um,
Warren, one thing we actually probably do disagree on, and it'll just be fun just to have a little fun disagreement, is crowding out. The theory that when the government borrows a lot, that a lot of the capital from the private sector goes to the government to fund the government stuff. So there's not enough money left over for private sector initiatives, private sector borrowing. I would offer, I feel like there's empirical evidence that when the government runs very large deficits, that actually is a period of very high private investment as well. Like in 2020, the government borrowed huge because they ran a huge fiscal deficit and a very short term bill issuance, the Mnuchin 2020, 2021. And then, but like the high yield bond, the corporate bond issuance as well was enormous. So I feel like I'm not seeing, and look, a lot of great investors and traders like Stan Druckenmiller are with you, not with me, but I just don't really see it.
well, I think you have to ask yourself, like it's a resource constrained world. How many in this economy? There are, roughly 2 million construction workers, a little bit less than that. And if you're going to run up, if the government comes in and says, let's do the CHIPS Act, let's do the Inflation Reduction Act, let's do some major non-residential construction spending. What does that do to interest rates? What does that do to the supply of labor? What does that do to the cost of money and resources? This is a resource constrained world. There's roughly 2 million construction workers. You can't train up a skilled construction worker overnight. So those people will switch somewhat between residential and non-residential, and you're crowding out residential construction labor.
Mhm.
And you have to price it. You're pricing it out, and that's the way I look at it. Is if you spend into a high capacity utilization economy, which is totally different than 2020. 2020 was the exact opposite of that. There's like there was no economy. The government had to spend to keep the wheels on the bus. But now everything's running, and it's running from certain sectors pretty hot, and you're competing for those resources. And I think that's part of the problem we talked about with small caps. And why is it that these interest rates are choking off certain parts of the economy while others are running hot? It's because the government is running industrial policy, and these resources are being gobbled up. So that's my really basic view of it. Is like, if you're going to spend, like, if you just create like a thought experiment where you say, okay, the government's going to, you know, I don't know what you could do it in the Chips Act, anything, just but make it really extreme and say we're going to build so many non-residential structures that requires 1.2 million workers to do that, to complete that labor, and the government's gonna spend that money come hell or high water.
Mhm.
So you've got 2 million workers. Now you only have 800,000 workers left to complete residential structures. So those projects in the private sector have to compete for that pool of laborers, and they have to compete for capital too, because what happens when the government spends that money out into the economy, it pushes up what everyone call it, the neutral rate of interest, the natural rate of interest, which causes these projects to be priced higher. So ultimately, that's the crowding out that I see. That's the on the ground how it takes place.
So you put it as a real crowding out of real resources. That makes sense to me. I typically think of crowding out being referred to as a financial resources are running out of. But in terms of actual labor and materials, sure, yeah, I guess that's true. Warren, my final question for you is: have you done any work on the financial sector? I guess I'm curious in the banks, but of course there's the financial sector, which includes banks, which as I mentioned, has been beating the S&P 500 as we this year as we record this. Excuse me, beating the technology sector in the S&P 500, and has gone on an extra leg higher now that President Trump won the election, and there's the sense that there's going to be deregulation. Maybe Basel III isn't going to go through. What does your models say about the financial sector at this point? Anything, valuations, outlook, anything? What do you think?
I think it's one of those trades that there's so much. I think there is a lot of liquidity out there in the markets, and you'll see. I think financials are keep doing well, more or less. I think that it's not really. So that's what I think. That's my outlook. Would I make it a cornerstone of my portfolio here? Not necessarily. I wouldn't. Our sector model is market weight financials, and I'm pretty comfortable with that. I think if you're underweight, you're probably going to underperform. But again, I think some of these things are pretty. Maybe you're into this stuff, the banking regulations deeper than I am. I'll zoom in there from time to time, but I don't see how the deregulation story translates to this super cycle of banking. I do think that some of the capital market unlocking, like some of that stuff, if you're going to have a mature bull market and things like that, some of these big money center banks, like it makes more sense, like a Goldman Sachs or J.P. Morgan. But they've run a lot, and they're pretty expensive. So, to me, again, they don't show up in our quality screens. They don't show up in our model. We don't own any of that stuff in our stock selection system. And our sector model is market weight on financials. So, you don't want to fade this kind of momentum, but I think it's long in the tooth.
And what is your sector overweights and sector underweights right now?
Our sector model is basically overweight tech, comm services, and a little bit of utilities. Market weight on financials, as I mentioned, and also market weight on consumer discretionary. And then everything else is underweights. I mean, industrial slight underweight, material slight underweight, healthcare is a big underweight, staples is a pretty big underweight too. And so that's kind of how we're positioned for November.
Interesting. So you are risk on in the stock market. However, you do see it is a late cycle. You do think that the economic cycle is getting long in the tooth. Long in the tooth implies that it's about to roll over, but aging. You even use the word aging.
Yeah, I just think exactly. You don't want to buy beta in low quality in a late cycle environment. You need a cyclical impulse to give you that. So again, I'm struggling to find that cyclical impulse. I think the street is relying on a plunge in rates based on a Fed rate cutting cycle. I think that's probably already priced into the bond market. So it's hard for me to get behind that cyclical impulse. So we're late cycle. I'm writing the high quality playbook, basically late cycle playbook with that framework. Now, if Trump comes out and does something like I said, where he blows the deficit out and cuts taxes across the board and then keeps spending high, that would be a pretty big impulse. But again, I need to see it to believe it.
We'll leave it there. Warren, thanks so much for coming on, sharing your research. People can find you on Twitter at Warren Pies and your firm 314 Research at 3F_research. Thank you so much for people watching. A reminder that people could find the show not just on YouTube, but on the Monetary Matters podcast, all podcast apps, Apple Podcasts, Spotify, and all other podcast apps. And a reminder to check out my business partner's show, Other People's Money, which is a show focused on the fund management industry and how to grow a hedge fund. Warren, thanks again. Until next time.
Thanks for having me.
Thank you. Just close the door.